We are joined by the man himself, Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. There's a look at oil. It's been tough, down almost 20% in the past 12 months. Eric, what's your take?
Yeah, we've been cautious since February, and I wanted to warn viewers, if you're long oil stocks specifically, we just don't think the risk reward is in your favor over the next couple of months. We're very, very bullish. At some point in 2026, we think the seeds have been sown for the next major bull market in oil. You've got the twilight of U.S. shale, so no more growth out of U.S. shale, the full normalization out of OPEC spare capacity. And we actually think the peaking non-OPEC supply, but between here and now, there's some obstacles. We have a surge of OPEC production between now through September. We've got the normalization, the end of that voluntary deal. That's 1.2 million barrels per day that the market is having to absorb. There's been a mismatch between the increase in production from OPEC and the increase in exports, because during the summertime, a lot of countries, namely Saudi, burn oil for air conditioning. Well, that's coming to an end. So we expect an increase in exports out of Saudi, the UAE, that the market has to absorb. There's also projects coming online in Guyana and Brazil that amounts to about 650,000 barrels per day at full capacity. And so as we look to October, it's seasonally, refineries go down for maintenance, so you have less demand, and now you have a very significant increase in supply. And so we think the possibility, and there's bookends on either side, but we think that we're facing very, very significant builds in inventories beginning in September and really manifesting themselves in late fall. And so I just think the cautiousness, as I look at an oil price around 62, 63, if the quantum of builds comes to pass, what we need to do is rein in U.S. shale. And that's not happening at 62, 63. We think there's modest declines. But if we're directionally accurate, we think U.S. shale is to fall, and price is going to be the governor of that. And so I just wanted to caution viewers, we think oil stocks at 60 are fairly valued. We just see much better upside in natural gas. And so for the fund that we manage, the Ninepoint Energy Fund, if you exclude some special situations like MEG and Athabasca, we only have a 10% weight outright in oil. That's the lowest, I think, ever.
10% weight in oil?
Yes.
Oh, my goodness.
Yeah, because if you think about like at current oil prices, stocks are fairly valued.
Yeah.
I think that there's been a political risk premium in the oil price that's been keeping oil propped up and at the same time preventing financial traders from wanting to go outright bearish crude. If there's any semblance of a deal between Putin and Trump and remove sanction risk on Russia, on India, et cetera, if it's just strictly on supply and demand, you always want a quantum of upside versus downside. I just think it's too evenly balanced and even more skewed to the downside. Where for natural gas, names have just been completely destroyed over the past month, down 15 to 20%. What we've seen is a very, very mild summertime, so there's been very little cooling demand. There was also for LNG plants some downtime. So as we look at natural gas, the strip for 2026 has fallen below the marginal cost of supply, which we think is $4. Companies will, we think, start dropping rigs, stop dropping frac spreads. So you'll get a supply response. And from demand, what we see is a very significant increase in LNG, so liquefied natural gas in the U.S. That's going to grow from about 16.5 to about 29 BCF for the next 5 years. AI, it's very, almost too froth in that theme. Yeah. But when you look at the backlog of companies like GE Vernova that make gas turbines, so to create the power for these data centers, their backlog is like 8 BCF a day. Well, that's like 7% of total market right now. So we just think there's a structural increase in demand from LNG, less so from AI, electrification, et cetera. And on supply, what we've seen in the U.S. is very good discipline on the part of U.S. producers. And we think that we're on the cusp of activity falling and a normalization. Because really what's hurt the thesis now has been the summer, where Mother Nature did not cooperate this year.
I should ask you about Baytex. That's been a drag on the portfolio. Are you still in that name?
No, we sold it a long time ago. We sold it around $4 late last year to early this year.
Oh, was that long ago? Oh,
yeah.
I see. Sorry, yeah. You just thought, well, you better opportunities.
We pivoted early February, March. We came back from Riyadh. We got a sense that OPEC may actually start returning barrels as opposed to postponing it. That came to pass. Yeah. Higher beta names that need $70 oil, we didn't think were going to work. So we pivoted towards natural gas. We were having a spectacular year Up until early July, natural gas fell off 20% as some of the air came out of the investment thesis on weather. But assuming a normal winter, assuming normal heating demand, we see very meaningful increases in demand from LNG as a couple more facilities come online. LNG Canada is starting to ramp up. That should eventually, once it reaches full capacity, decrease the discount for Canadian gas from roughly $2 to $1.20. We hope.
But the Alberta gas price has been so disappointing despite LNG Canada. Yeah.
And the biggest reason, I think, is that unlike U.S. peers, certain Canadian natural gas producers grew production into that increase in demand. And at the same time in Alberta, they had a miserable summer, so you've got high storage. And there was also some downtime in terms of certain pipelines getting gas out and some gas plants as well. And so you've had excess supply, low demand, even more so in Alberta. So that's expressed itself in a very, very weak natural gas price. But so if I look at it in terms of where do we want to make money between now and, let's say, over the next 6 months, we're very, very bullish on oil at some point in 2026. How can you not get excited? OPEC will have fully normalized its spare capacity, 2 million barrels per day, effective like next month. U.S. shale production, we've talked about for a year at least, in terms of, we see the end of it coming.
The growth.
The growth. Now, that's now over. And so now we have to debate how much is it going to fall. That's the biggest source of supply over the past decade for total supply. And then we look at, yes, there are production growth from Canada, Guyana, and Brazil. Well, there's declines elsewhere in the world. And so non-OPEC production, that's 2/3 of global supply, that growth is now coming to an end. So there's the setup for a bullish tape for oil. There's just a bit of, there's cause for pause over the next 4 months, 6 months. And so we look at, the prospect of meaningful builds. Hard to see oil meaningfully going up in that tape versus natural gas has been completely brutalized. So there are certain names that we like much better in gas than oil.
We've only time to get to one of your names here, Expand Energy. It's EXE in New York. What are they all about?
Yeah, so this is a $22 billion natural gas producer. They're the biggest natural gas producer in the United States. They're in the key areas of demand, so U.S. Gulf Coast for LNG. They're now trading at a 14% free cash flow yield.
Expand Energy,
yes, at $4 gas.
Because we're having trouble with the graph. I'm sorry,
so
go on.
EXE. So you'll note it's sold off probably 17% over the past month as natural gas has come off.
Okay.
We're looking to the 2026 strip. It's roughly $3.70-ish. We're using $4 because we think that's a marginal cost of supply. You've got a gas name with 25 years of inventory, trading at roughly 4.2 times cash flow and a 14% free cash flow yield. They continue to buy back stock. They pay a dividend. And so we think that the natural gas was a consensus long. That enthusiasm is completely wiped out. So you're starting from a very low base. If we have a normal winter, LNG facilities continue to come on, you get a production response, we think this stock could do very, very well.
Yeah, I'm showing a yield of 3.4%. And you like the look of NuVista and EQT, but we're out of time, Eric. I'm very sorry.
Thanks for having me.
Eric Nuttall of Ninepoint Partners.